You acquired your uncommon wisdom through the furrows of an Ontario farm, the deeds of a beloved grandparent, and the antics of a TV comedian. I told you they were comedians. You didn't believe me. Can you explain what that means to us?
My family actually came over from Scotland in 1823 and settled originally in Lachine. They then went to Ayr near Kitchener-Waterloo and homesteaded in 1845. That farm is still in the family, and I, in my teenage years, would go up and work on the farm. So I know how to milk cows, how to stoke hay bales, and all sorts of fun stuff. My grandfather was Chief Justice of Ontario. He was a gentleman who, after World War I, he served at Vimy Ridge as a gunnery officer. After World War I, came back and articled in law in Peterborough. He actually had Tom Thompson's and gave them to the gallery in Kleinburg. That sort of a background teaches you to do right by people. I also like talking about different types of investors. The reference to Mr. Bean is behavioral. Too many people look at what other people are doing and try to imitate them. And if you watch Mr. Bean on TV, what you'll see is his behavior is always glancing slyly sideways to see what other people are doing, and then he will attempt to do what they are doing. When you're investing, that's a disaster, because you do not go towards your personal goals. You are distracted from them.
No, that's a phenomenal answer. I'm going to leave you with one question. Can you explain what the Brendan Wood International TopGun Asset Management Team Award is and what it means to have achieved it in your industry?
It means that you've assembled a team of portfolio managers who are recognized by the sell side as being absolutely best of class. We share that award with organizations like Royal Bank Investment Management, the Caisse de Depot, Dundee Wealth Management. This is pretty good company to be in, and it's very unusual that a little firm like Sentry, we've really only been in the mutual fund business in a serious way for about 4 or 5 years, is being recognized. I have individual team members, Kevin McLean, who is recognized as one of the leading minds in mining on a global basis, Dennis Mitchell on real estate, Mike Simpson on equity investing, and Mason Granger on oil and gas. Now, I've got a presentation here titled Finding the Sweet Spot Between Risk and Return. What you're going to find in these 3 presentations is 3 gentlemen who all have in some way similar approaches. We understand risk, we manage risk on behalf of clients. We all come from different backgrounds, but we all interact with the end buyer of our funds. My personal background is I started in August of 1975 in the investment business. I was a trust administrator and then trust officer at National Trust. I handled estates, agencies, and I dealt with the complex outcomes that arise out of having capital. Now, in an estate, what you will have is 2 conflicting goals. The people who are entitled to the capital of the estate at a future time are looking for that capital to grow. The life tenant, the income beneficiary, is looking for that capital to provide an income stream, and for that income stream to grow over time to offset inflation. Now, when the beneficiaries come from the same family, generally there's a compromise that can be reached. But heaven forbid the children are the children of a first spouse, and the life tenant is the second or third spouse. You frequently end up with serious interactions. It was very useful for me at the beginning of my career to start learning about the compromises that you need to make in investing. And I'll talk to some of them as we go through my presentation. The lawyers insist I put a disclaimer in because I make forward-looking statements. I speculate on outcomes, and you really should consider getting independent advice before you act on anything that I suggest. We talked a bit about the company accolades. This Lipper Award for Best Equity Funds Group is actually very serious. The 2010 award says in effect that our equity family protected capital best in 2008, reinvested and appreciated in 2009, and dealt with the correction in 2010 effectively. This is the most volatile 3 years in market history since the 1930s. And we steered our way through with the best risk-adjusted returns in the industry. To repeat it in 2012 was very gratifying. We have individual fund awards. We pay our portfolio managers on risk-adjusted returns. We do not seek volatility, we seek consistency of return. And when you hear from John and you hear from David, you're going to hear the same message. Volatility is not desirable, and chasing after hot stocks is a recipe for disaster. Now, I mentioned Mr. Bean as one of my archetypes. Another one of my archetypes is the farmyard dog investor. He sees something moving, think Facebook, and has to have some of that. And when he gets run over, it's not my fault, it's his fault. Take responsibility for your actions. Now, I have to forecast the future. I have to have a view. And my view is based on my understanding of history and my understanding of past market activities. The norm for the economy is to grow. So I will invest for long-term growth. I've been in this industry now since 1975. I've been alive since 1952. And during that time frame, North America has been in recession just about 10% of the time. I don't invest for that 10%, I invest for the other 90% of outcomes. This is the first business cycle where emerging markets are driving global economic growth. Now, the solution in Canada apparently is we have to go speculate on commodities in order to access emerging markets. Personally, I don't think that's a very sensible way of approaching it. But I'm going to give you a couple of little facts that you can keep in mind when you read the headlines. Greece, which is dominating the news, is 0.37% of global GDP. It is irrelevant from a GDP point of view. Europe in 2000 was about 17.5% of global GDP. It's down to around 13.5%. The developing world was 37% of global GDP. It's now almost 50%. And according to IMF data, emerging market growth currently, developing market growth, is the fastest growth in the post-war period. And when you aggregate developed world and developing world growth, the recovery since the bottom in 2009 is the fastest recovery in post-war history. In the developed world, it's an anemic growth rate, but it's roughly the same as the growth rate in 1991. The media isn't telling you this. They're telling you that you are still in recession and the world is getting worse. I disagree. Now, I don't pay a lot of attention to economic forecasts. The forecasters really aren't that good. This black line is the actual US GDP, and the light line is the forecast from a year earlier. The forecasters completely missed the 1981-82 recession. They were in the process of missing the 91 recession. They caught it on the recovery. They missed 01, and they were in the process of completely missing the 08-09 recession. I can't invest on forecasts like that. I can't turn my ship that quickly. But what I can do is invest based on the yield curve. You're going, what are you talking about, McIntyre? The yield curve is where are short rates? Today they are 25 basis points. And where are long rates? In the United States, they're around 3%. When you've got a wide differential between short and long rates, expect the economy to be in expansion mode. When short rates get close to long rates, it means central banks are tightening and they're trying to slow the economy down. No central bank is likely to tighten in the developed world for the foreseeable future. They want this cycle to continue. The solution to too much debt is economic growth and inflation. The central banks have also told you that they are targeting inflation. The Bank of Canada has an explicit target of 2% inflation. The US central bank does not have an explicit target, but since 1932, US inflation has averaged 3.4%. So when you buy a guaranteed investment, give the government of Canada $100 to buy a bond that matures 10 years from now, and accept an interest rate of 2%, you're actually not making any money. They're not paying you back $2,012. They're paying you back $2,022, which have purchasing power equivalent to 80 cents. That is called inflation. How many in the room understand the rule of 72? Okay, that's good. The primary school system did work at one time. My older sister taught in the primary system. She doesn't understand the rule of 72. You divide an interest rate into 72 and it gives you your compounding period. Now, in bonds, if I divide 2 into 72, it tells me that I will double my money in 36 years. It also tells me that the purchasing power of my money will be cut in half in 36 years. Inflation is like radioactivity. It decays. Guys who talk about stocks frequently talk about insane growth rates. Market's going to grow at 20% annually. Companies' earnings are going to grow at some silly percentage. Doesn't work that way. This is from January 54. I find this is really weird. I am a data geek. I got all sorts of data, but none of the data from before when I was born is reliable. I just don't understand that. I can't get accurate data before 54, 56, 60, depends on the database. This is earnings of companies that comprise the S&P 500. From 1954 through to the end of March, they have grown at roughly 6.5% compound annually. Sometimes they go down, but they recover. Sometimes they go down, but they recover. I've got a 5-year average of the earnings here. I actually run long-term valuations. When the bears here in early 2009 were saying the market is wildly overpriced, I was scratching my head saying, well, yeah, we've got trough earnings, but these companies will recover. I was buying because I saw mispriced opportunity. And we're actually back to trend line. You may not be aware of this, but trailing earnings are roughly $98 on US companies. They are at record levels. They're far better than they were before the crash in 07. They've grown, despite weak economic growth, by 6.3% since 2000. And they've grown because of an expansion into global markets and through productivity. The productivity explosion in the United States is actually spectacular. They are producing more goods today than they did 5 years ago with, unfortunately, fewer employees. This is the stock market over generations. And I've based it back after the crash in 1932, and this slope is 6.6%. Company earnings grow with GDP, and the value of the businesses grows with GDP. And it is quite simply because the goods and services that these businesses sell can be repriced into a new currency with inflation. So if I went back today and took a US dollar and went back to 1932, I would be able to buy 6 cents worth of goods or services. Now, every so often, the market does way better than normal growth rates. Generally, you're going from a low valuation, a low PE 8 times, to a high valuation, 21 times in 1968. Now, in 1968, that's roughly when The Graduate came out. I can remember a wonderful scene where some dude who looks like Don Draper's got his arms around Dustin Hoffman and says, "Plastics, young man." It was a nifty 50, one direction investing. Start of a bear market. You go sideways for really what's about 16 years, but the important thing is if you had dividends, you made money. And once the market finally put a big bottom in 1974, you actually started a new long-term uptrend. You buy when stuff's cheap, and you sell when stuff's expensive. In 2000, in the tech bubble, that's when I became the income trust guy. I recognized that there was no way you were going to make money in the stock market. Its valuations were insane. We went sideways now for 12 years, but I think we put a very major bottom in 2009. And I'm willing to bet when I come back 20 years from now, I come from a long-lived family, we're going to see a pattern that looks like this. Cyclical market moves, up and down, going higher. It follows depreciation of currency, inflation, growth in GDP, growth in earnings. And if you can buy stocks relatively cheaply, think yield. We talk about PEs, which are meaningless to you. A 10 PE is a 10% earnings yield. A 15 PE is a 7.5% earnings yield. A 20 PE is a 5% earnings yield. We've actually got to get to around a 38 PE to get down to a 1.7% earnings yield. I look at relative valuations. What's expensive, what's cheap? And I tend to be a value investor, so I buy what's cheap. This wildly squiggly line chart takes the difference between what I could get on a 10-year bond and what I have as the earnings yield on the stock market. So you go back to December 1974. This was after that really nasty bear market I pointed out. You had an earnings yield of 13.6%. The 10-year was 7.4%. And the differential was approximately 6%. You were getting 6% higher yield on your equities than you were on your bonds. In 2000, when I was no longer interested in the broad stock market, I was getting 6.8% on a 10-year bond. I was getting 13% on income trusts. So you know where I went. And you were getting an earnings yield of 3.4% on the stock market. Stocks were expensive, bonds were cheap. 1987, 10 years, over 10%, earnings yield 4%. Stocks, expensive, bonds cheap. When I'm down here, I'm a buyer of fixed income or yield. When I'm up here, oddly enough, I'm a buyer of growth because growth is mispriced. Now, I need growth in a portfolio because I come from a long-lived family and I need my income to grow over time. The only way I can grow my income over time is to own securities that pay dividends and grow those dividends. Now, I have to ensure that the companies stay in business, so I open up those annual reports and I look at the balance sheet and I check liquidity. Our business is managing money. It's managing money for the world of investors. But as a trust officer, I recognize that many of the manufacturers out there don't actually deliver to the end investor the right product. Now, most investors will write an account opening form when they deal with an advisor. And the account opening form will have some combination of, I want long-term growth in my capital, I want preservation of capital, I want an income stream, or I will intend to retire in 5-7 years. I need a future income stream. Over my career, I've had very few clients who actually came in and said, I expect you to beat the market in all periods. Now, when I get those clients saying, I expect you to beat the market in all periods, I fire them because their expectations are unreasonable and, quite frankly, unachievable by any manager. The correct way to manage your money is to recognize what your personal needs are. Now, if you're 65 years old and you're using income off the portfolio to supplement a pension, ensure that you are covering your income needs. And while you can raise cash when markets are expensive, make sure you're covering your income needs. Otherwise, you're spending your capital. My mother actually was a stockbroker once, and she is still very interested in the market. She is going to be 90 in May and is 93% in equities, but they all pay dividends. And this January, she called me to thank me for keeping her in dividend growth securities because the only way that she could have survived a long retirement was with income growth. We run equity income portfolios. We focus on the characteristics of businesses that can grow dividends. We turn out periodic little pieces that we send to the Johnson Legacy team, which are our dividend aristocrats. These are the companies that have increased their income to us that year, that quarter, or that month. The names that we own are not big index names. What we're looking for are real-world businesses that, quite frankly, deliver multiple repeated transactions that are integral to the structures of daily life. and we harvest profit off those transactions. You need some energy, you need some insurance, railways, telecom, food, fertilizer, convenience stores. Think about your personal spending baskets. If you pay a cell phone, internet, and cable bill to TELUS, why don't you own the stock? If you bank at the Royal Bank and you buy GICs from the Royal Bank, why don't you own the stock and collect the dividend? Get paid back for the fees you're paying them. I keep track of how much capital it requires to earn an investment income. Funnily enough, if you have a balanced portfolio today, you need about $1.6 million to generate $45,000 in income. Most people don't have enough capital. A bond portfolio, you actually need $1.6 million to do the same. You're guaranteed of getting your money back from the bond portfolio, and there may be some volatility if interest rates go up. On the stock portfolio, you don't have any guarantees, but you do have an option on growth, that you will have dividend growth over time. This classic balanced portfolio, 40% in bonds, 40% TSX, 20% S&P 500. Back in 1997, $1 million generated $44,000 in income. Today, that portfolio generates about $38,000 in income. The actual income has declined as interest rates fell. An investor who needed $44,000 in income back in 1997 would want that income to grow with inflation. The income need today would be approximately $65,000. This balanced portfolio, the spread between these two lines is capital that's paid out to supplement the income. It's capital appreciation that's harvested, and in down markets, it's just capital being paid out. The portfolio has gone up the mountain. In the bear market in 02-03, it actually came back to $1 million. It went up the mountain again, and in the bear market of 09, it came back to $1 million, and it's slowly trying to go up the mountain again. And an income investor who sells at bottoms never gets price recovery. You should be selling peaks. And Dave will talk to you about how you do that, because he's actually got a very good presentation on that particular technique. One of the things that retail investors fear is the volatility. What we've gone through over the past 5 years is the most volatile period since the 1930s. One little thing to keep in mind, though. The second most volatile period since the 30s was around the unwinding of the tech bubble. And once we settled down into an established economic expansion, volatility died down. Corrections became much more benign, and people were comfortable letting their capital ride. We are trying to settle down into a period of lower volatility, but there are these continual macro scares out there. Headlines in Greece. You're going to have some really nasty news, by the way, over the next 3-5 weeks, as the brother-in-law in Greece decides that he's not going to repay the family loans. And Greece decides to follow the Argentinian model and go bankrupt. Think about when these headlines come across, whether Greece going bankrupt has any correlation to a barrel of oil shipped on the Enbridge pipeline. Is it going to affect your purchase behavior when you go to buy milk and bread? And if the assets, the companies that produce the goods and services that you require become meaningfully cheaper because of dislocation in Greece, you might want to take advantage of the opportunity. The most money you make in investing is when you take advantage of opportunity at the peak of chaos. And oddly enough, the people who did best in the crisis in 2009 were retail investors. They were the buyers through the decline into March. It wasn't the institutions. The institutions were sellers. I read the paper, and I don't know, about every week or two, Rob Carrick will have an article in there on the virtues of ETFs and index investing. And he may be right, but in my experience, I don't like to own stuff that is not investable. Now, I look at the TSX index. It's got what I call high beta sectors. These are high volatility sectors. The financials are over 30%, and low beta sectors. This particular table looks at sector weight. 48% of the index is in high volatility sectors. They have an average volatility that is 49% above the index. And they have an ROE on average that's 11% below the index. ROE is return on equity. When you're investing in stocks, you have people in front of you who have claims to the cash in a business. The first claim is the tax man, then employees, then the bank for interest, secured creditors, and then unsecured creditors. Anything that's left over at the end comes to you as the shareholder. I look for high return on equity and low volatility. And where I can find those characteristics, the volatility is 0.7 of the return on equity in telecom. I'm really interested in a buy and hold strategy. Where volatility is high and return on equity is low, I'm not interested in buy and hold. I'm interested in possibly trading or just not owning that stuff. Long term, your best performing asset class is equities that pay growing dividends. This is a Merrill Lynch study out of the United States. Covers a generation of returns, not the highest yield, second highest yield group. High yield is an indicator of risk. Moderate yield, well covered, grows year by year by year. Highest return, lowest volatility. If my client signs a form that says, I want long-term return of capital, preservation of capital, and an income stream, that's where you go. And if you're lending money, make sure the borrower can repay. The people who loaned money to Greece were nuts. They don't have a functioning tax system. The borrower cannot repay. We do credit work on all the companies that we invest in. It's credit work that protects your capital. Make sure your price is right. You can get 1.7% yield on a 10-year treasury, and the current inflation rate's 2.5%. Your price is wrong. You're losing money. But you've got to promise you'll get your money back in 10 years. Remember this? Defense wins. So play defense. With that, thank you.